September 16th, 1992. The British pound is in free fall. Traders are dumping it, investors are panicking, and the Bank of England is burning billions trying to stop the bleeding. By the end of the day, the United Kingdom is forced to exit Europe's exchange rate mechanism. The pound collapses, yet one man makes over $1 billion in profit. His name is George Soros, and this moment will forever be known as Black Wednesday. So how did a hedge fund manager take down the Bank of England? Let's break it down. In the early 1990s, Europe had a dream, a united economy with one currency, the euro. But before adopting a single currency, countries needed to stabilize their exchange rates. That's where the exchange rate mechanism, or ERM, came in. It was like a currency club. Each member had to keep their currency's value fixed within a narrow range, relative to other members, especially the German Deutsche Mark. The UK joined the ERM in 1990. At the time, inflation was high and interest rates were rising. But the British government hoped that by joining the ERM, they could stabilize prices and prepare for the euro. The problem, though, was that the pound was pegged at too high a rate, and the UK economy wasn't strong enough to support it. By 1992, Britain was in trouble. Unemployment was rising, house prices were falling, and interest rates were painfully high, just to defend the pound's value. To stay in the ERM, the Bank of England had to buy pounds using its foreign currency reserves every time the pound weakened. It was like trying to hold back the tide with a broom. Meanwhile, Germany had just reunified and was facing its own inflation problems. The Bundesbank, Germany's central bank, refused to lower interest rates to support other currencies. That made things worse for the UK. Money kept flowing into the stronger Deutsche Mark and out of the weaker pound. Naturally, speculators started to circle. George Soros, the founder of the Quantum Fund, saw the writing on the wall. He believed the pound was unsustainable at its current rate. The UK could either raise interest rates even further, risking a deeper recession, or devalue the pound and exit the ERM. Soros chose to bet on the second outcome. He built a massive short position, borrowing billions of pounds and selling them on the market. His plan was simple. If the pound crashed, he could buy them back at a lower price and pocket the difference. By mid-September, his fund had sold more than £10 billion. He wasn't the only one. Other hedge funds and traders joined in, and the pressure on the pound became overwhelming. On the morning of September 16th, the Bank of England fought back. It raised interest rates from 10 to 12%, then to 15%. It spent billions trying to buy up pounds and support its value. But it didn't work. Soros and others kept selling. The market didn't believe the UK could hold the line. That evening, the British government gave in. They officially withdrew from the ERM and let the pound float freely, and the currency dropped like a rock. George Soros walked away with more than $1 billion in profit, while the Bank of England lost billions of pounds in reserves. The UK Treasury took a hit that would take years to recover from. Black Wednesday humiliated the British government. It damaged the credibility of the pound, and it ended the political careers of several top officials. But ironically, the UK economy began to recover soon after. The floating pound made British exports cheaper and more competitive. Interest rates could finally come down, and inflation started to ease. As for George Soros, the press dubbed him as the man who broke the Bank of England. His bold, contrarian move became one of the most famous trades in financial history. But more importantly, it revealed a deep truth. No matter how big or powerful a government or central bank is, if market fundamentals are against you, defending a currency becomes a losing battle. Black Wednesday was more than just a crisis. It was a turning point in modern finance. It showed how quickly policy, politics, and speculation can collide. And it proved that in a world of free-moving capital, even the strongest institutions can be vulnerable. Remember to follow Trading Key as we uncover more market stories behind the world's biggest financial events and the lessons every investor should know.